Today on BlockNexus TV, we need to talk about three big stories shaking up the crypto market right now. Solana's nasty bull trap, a $90 billion wave of panic selling, and why some smart money is quietly rotating into structured staking plays like Sol staking, while everyone else is frozen in fear. Let's start with Solana. Recently, SOL looked like it was breaking out, pushing above a key resistance zone around $88, only to slam straight back down. That failed breakout is now being labeled a classic bull trap, with price slipping back into its previous range and flipping the short-term structure from bullish to clearly bearish. Late buyers got caught at the top, and as Solana failed to hold above its point of control, the price area with the highest trading volume, sellers took back control and opened the door for a deeper move down. Right now, traders are laser-focused on the $78 region as the next major support for Solana. That zone lines up with the lower boundary of its broader trading range and sits near a key 0.618 Fibonacci retracement level, which often acts like a magnet during corrections. If SOL slices cleanly through that level, we could see a full range rotation lower. But if price dips below 78, grabs liquidity, and then quickly snaps back above, it could form a swing failure pattern that sparks a sharp reversal rally. Zooming out, Solana's bull trap is just one piece of a broader risk-off mood. In a matter of hours, around $90 billion in value evaporated from the crypto market as Bitcoin fell below $66,000. Ethereum slid toward $1,900, and many altcoins dropped between 4% and 7%. Sentiment has flipped hard into extreme fear on the popular Fear and Greed Index, reminding everyone how fast unstructured exposure can bleed in a high-volatility environment. This is where smart positioning comes in. Instead of just holding and praying for a bounce, some investors are turning to structured staking models that keep capital working even when prices are chopping sideways or drifting lower. One example getting attention is Sol staking, a platform that combines automated staking and cloud-based participation with exposure to diversified real-world assets, so the strategy doesn't rely purely on token price going up. Sol staking's pitch is simple. Volatility isn't the real enemy, passive exposure is. The platform is operated through a U.S.-registered entity, Sol Investments LLC, with user staking assets kept segregated from operating funds. Periodic independent audits by PwC, custody insurance from Lloyd's of London, and enterprise-grade security with layered encryption and 24/7 risk monitoring. The goal is to build something structurally resilient, designed for long-term operation instead of short-term hype cycles. What makes it different from many staking schemes is the integration of off-chain, revenue-generating assets. We're talking AI data center infrastructure, sovereign and investment-grade bonds, physical gold and commodities, industrial metal inventories, logistics and cold chain operations, plus agriculture and clean energy projects. These real-world assets generate cash flows that are reflected on-chain through automated contracts, so the underlying engine can keep running even when crypto prices are under pressure. Users can participate in Sol staking contracts with assets like BTC, ETH, ETH, SOL, USDT, and more, with automated execution, daily settlement, and transparent tracking built into the system. Exact yields and terms depend on the specific contract type and time horizon, so anyone interested needs to review the current plans on the official site and understand the risks before jumping in. Meanwhile, macro conditions are adding even more uncertainty. The overall crypto market cap is hovering around $2.34 trillion. Bitcoin is trading near 67,000, and Ethereum around 1,980. But price action has been choppy as traders react to new comments from the Federal Reserve. Austin Goolsbee, head of the Chicago Fed, just signaled that if inflation keeps drifting toward the 2% target, there is room for several interest rate cuts later in 2026, even though the latest dot plot still shows only one cut penciled in for this year. Recent data showed headline inflation easing to about 2.4% in January from 2.7, with core inflation at roughly 2.5%, continuing a downward trend. A more dovish Fed, with more cuts than currently expected, historically supports risk assets like Bitcoin and altcoins, as we saw during the pandemic era when aggressive easing helped push crypto to new highs. On top of that, hedge funds and large managers are increasingly bearish on the US dollar, with positioning at its weakest level in over a decade, and a softer dollar often acts as a tailwind for crypto, since most coins are priced in USD. All eyes are now on the upcoming release of the Federal Reserve's meeting minutes, which could offer more clues about how quickly policymakers might move and how many cuts are really on the table. For crypto, that means we're in a strange spot. Short-term fear. Bull traps on names like Solana, but a potentially supportive macro backdrop building in the background. Those who survive these conditions tend to be the ones who respect risk, avoid chasing obvious traps, and build structures, whether through diversified staking platforms or disciplined trading plans, that can operate through the storm instead of only in the sunshine. If you found this breakdown helpful, tap like, hit subscribe, and drop a comment. Are you sitting in stablecoins, stacking Bitcoin, or exploring structured plays like soul staking in this volatility? Your strategy might inspire our next deep dive.